Here in the U.S., we have recovered somewhat in the equity market in that we are well off the lows of the session. That's a 2-for-1. President Trump saying you have a first deal on tariffs. That's very close, and they'd love to get a deal with China. That helped to move the S&P off the lows, but we're still down 3%. It did nothing, though, when it comes to the dollar and the bond market as well. Those sell-offs continue. 10 basis point move on the 30-year yet again. We're looking at like 54 basis points over the last 5 days. And Bloomberg Dollar Index, the biggest sell-off that we've seen since 2022, Scar.
So clearly, it's from U.S. exceptionalism to sell everything American. Yesterday's tariff reprieve did not last long, with U.S. stocks resuming their decline, bonds not getting much love, the dollar sliding, and corporate credit default risks rising. Now, reality is setting in that President Trump has narrowed his trade war into a high-stakes showdown with China. According to the White House, tariffs on China are now at least 145%, and Beijing shows no signs of blinking. So investors need to position for an economy that's likely to get worse before it gets better.
We might have to go through a brief recession in order to rebuild our foundation. And you say, how much longer can investors hold? You know, look, the market's not up and to the right, every year of every decade.
And companies are now doing the hard work of forecasting through a fog of uncertainty. CarMax following Delta and pulling its guidance, in this case, backing away from the timing of its financial goals. Others are deciding whether to absorb higher costs or raise prices, and then by how much. We're going to be speaking with Stu Leonards later in the program to hear how the grocery chain is positioning itself. Alex?
All right, taking a look at what we're about the relationship between the equity market and other asset classes here, I thought it was worth taking a look at the 30-year and the S&P. And this is a normalized chart that goes all the way back to the beginning of the year, and they relatively moved somewhat in tandem. Now, the real dislocation started around Liberation Day. Let's take it back about 5 days ago, and you saw a huge move higher in the bond market as equities also drifted lower. So the question is, with this big gap between yields and the equity market, which one's going to be right? How can the equity market stay risk on in any meaningful way when the 30-year yield continues to grind higher? As I mentioned, you had a 54 basis point move in the last 5 days in the 30-year. The traditional kind of assets in the bond market shouldn't be moving like that. So how do you take on true risk positions within the S&P, Scar?
All very good questions. So let's kick things off right now with Gargi Chaudhary. She's Chief Investment and Portfolio Strategist of the Americas over at BlackRock. And Gargi, I want to start with that idea that the bond market is driving everything right now. Given the volatility that we're seeing there, how do you begin to price other assets?
Good afternoon. It's good to be here, Scarlett. So absolutely, on your point on the bond markets, obviously the auctions this week having passed, that I think they were big clearing events, especially the 30-year auction, that having gone off reasonably well, as well as the 10-year. I think that is giving a little bit of a pause to that vicious sell-off that we'd seen. Obviously, yields are higher today as well, but only on the very long end. The front end is still a little bit more stable. So I think from here on, we have to acknowledge that there is still uncertainties ahead. And I think the market got very excited yesterday when we saw that headline come through around 1 o'clock. But we still have slowing growth. We still have companies that I think are going to either pull guidance or at least cautiously guide lower. And then lastly, we still have the most liquid market in the world, the Treasury market, behaving in manners that can be quite panicky.
Did you guys have any signals that over the last few days there were liquidity issues in the Treasury market, or no?
You know, so a couple of things that we look at, obviously, number one, how ETFs trade. And that's one where the signal's been very good. ETFs as a percentage of the total tape being over 40%, that means risk is changing hands. There is that release valve in the markets. That's good. We also look at on-the-run and off-the-run spreads. Remember back to 2020 during the COVID illiquidity crisis where all of those spreads blew up pretty wildly. I think keeping an eye on that. And then repo markets. That's really big. Understanding, making sure that there is no massive swings there. And so far, again, those signs are not pointing to massive panics or anything that should suggest that the Fed needs to step in yet.
Also, as well, what companies do and whether they proceed with their original plans. A couple of companies began tiptoeing back into the corporate bond market to raise some money. I know that Japan Tobacco, AutoZone, Diageo, among those marketing new bonds. As long as things like that keep happening, that's a good sign, isn't it?
I think that's an important sign to keep an eye on. Obviously, any kind of news that deals are getting pulled back is not a good sign, especially in times of stress. So yes, functioning in the markets is credit trading well, ETFs trading and being a large part of what the total trace volume for high yield markets are. I think those are all great signs, and we're seeing that so far.
Is the U.S., though, in some asset classes trading like an emerging market at this point?
The one thing that, especially last week, when we saw that at one point saw a 72 basis point swing from the lows in 30-year yields to the highs in 30-year yields overnight, as well as at the same time the dollar sort of going down maybe slightly, it did feel a bit scary. I won't go as far as to say trading like an emerging market, but it didn't trade how you would have expected it to trade. Having said that, look, at this juncture, we're just now learning about the impacts of growth. It's still too early to say that we're absolutely going into a recession or not. I think we all have to recognize that whatever your expectations of growth were on February 19th, the peak, it is much lower than that. Now, is it recession? We don't know yet. And whether it's going to continue to trade in a panicky fashion, we think investors should be adding hedges.
Right. And Larry Fink, of course, spoke earlier this week saying that for a lot of companies, they're already feeling like they're in recession now. How does this set us up for earnings season? Because obviously, everyone's going to be fixated on what company management say about what they see. And there's really no upside for being too specific in your outlook right now because there's so much that's unknown.
So a couple of things that we're noting there is, number one, to what extent, like normally we get about 20% of companies that obviously guide forward, or 43% of companies that give you full year guidance of some sort. So to what extent is that getting pulled back meaningfully? And number two, to what extent are, instead of pulling back or giving no guidance, to what extent is it moving further negative? So right now, the spread between how many companies are guiding positively versus negatively, the negative is picking up significantly. That spread is the highest it's been in a decade, which makes sense. People are saying zero earnings growth for 2025. It's still too early. So what I will be watching for, number one, what are companies saying around what they're going to do around their margin protection? Are they pulling back CapEx? We're going to be watching for those kind of headlines. Are they going to do anything about headcount adjustments? Probably still too early for that, but certainly looking out for any signals there. And lastly, what kind of future guidance for the full year 2025 they're able to provide.
That's why I was so confused when Walmart was able to reiterate their guide for 3 to 4% growth. Like, how do you know that at this point when they were in the middle of all that turmoil? You mentioned earlier about adding hedges. Where, how?
Absolutely. So a couple of things that we're thinking about. First of all, let's look at what has worked in this kind of volatility and what hasn't. Certainly, assets like gold have worked. Assets like long duration, unfortunately, have not. We have a couple of market neutral strategies that have worked really well, that are up for the year. We have global equity market neutral strategies that have done super well, especially when you look at broad equity markets. We think adding those, what we like to call diversifying diversifiers. So usually bonds were your diversifiers. Now you diversify your diversifiers with other sort of market neutral strategies, add things like gold, and then frankly, add a little bit of defense to your equity portfolio as well. So don't move to cash. We don't think this is the time for that, but maybe going towards things like US minimum volatility strategies, which again have outperformed by 1,000 basis points since the peak of the market.
All right, Gargi, hang out for 1 second. Gargi Chaudhry, Chief Investment and Portfolio Strategist at BlackRock. She's sticking with us. We do want to briefly touch on some of the company stories today, and one is U.S. Steel. That stock is down by 8% after President Trump reiterated his long-held position. He doesn't want to see the steelmaker owned by a Japanese company. Bloomberg News' Joe Doe joins us with more. Joe, can U.S. Steel survive on its own?
Yeah.
Okay, so why is it stock down?
Everybody is just paying attention to a deal. And to be clear, this market is what's happening in the broader markets is affecting U.S. Steel, right? Like last week I was on the phone with an arbitrator who you could call in any day and say, okay, what's the stock price of U.S. Steel saying right now about the probability that a deal will happen? And this particular person said, I guess it was on Wednesday, I don't know, because right now the markets are such that we're having trouble pricing the fair value of the steel market.
Ah, I see.
But putting that aside, U.S. Steel, I mean, this is like a crazy chart, right? So the President of the United States yesterday afternoon after the markets closed came out and said in so many words when he was just talking about the steel market, but decided to talk about U.S. Steel, I don't want U.S. Steel to be owned by a Japanese company or any other, which we think he was referring to other foreign companies. He came back today in the cabinet room and was asked about steel, in particular tariffs, and he said, and by the way, the tariffs are helping the steel industry, they're helping U.S. Steel, that's why U.S. Steel doesn't have to be owned. And then he threw in another comment, which was, we like Japan, we like Nippon Steel, they're a big, great company, but we think they should be an investor. We've heard that comment before. The investor comment came back in February when he said he didn't want them to be majority owned by Nippon Steel. He wanted them to be an investment. We had reporting back in February that said when the President of the United States said that, the two companies were shocked by the comment. They didn't know that was a comment that was coming. And the question the market had was, what does an investment mean? My point is, we're back at that point. What does an investment mean? We thought Monday, wow, they're going to re-review this CFIUS review, the National Security Review, going to give them 45 days, and that'll give the President of the United States the cover to say, you know what, maybe it's a good deal.
So investors want to see something happen with U.S. Steel. U.S. Steel wants to stay independent. Are there any other tie-ups, maybe domestically, that could be in the works or are being discussed?
Sorry, to be clear, U.S. Steel doesn't want to stay independent, right? U.S. Steel has said we like the deal on the table, which is the $55 all-cash deal that Nippon Steel, but it could survive on its own if it had to. What are other options? I mean, there are plenty of rumors out there, but this is the focus right now of all the biggest holders. You're trading at, I don't know what we're at right now, 45, 46?
41.56.
41. Sorry, that was a few days ago.
Right.
We're still well below that $55 a share offer, but you can ask any of the investors, they would say, give us the $55 a share and let's get out of here, and then we'll let Nippon figure out how to operate the company moving forward.
So do the tariffs actually help steel companies because they increase steel prices so much? In theory, right?
In theory, they help them in the short term.
But
in the long term, it's a lot more questionable because then you're getting into the variables of actual fundamentals in the market. Construction's being crushed, the automotive market's looking weak, and now we have these across-the-board tariffs that I think it can go without saying have affected the entire calculus behind the markets, and that hits everyone all the way down to U.S. Steel.
All right, lots of unanswerable questions here when it comes to U.S. Steel and how it moves forward. Bloomberg's Joe Do, thank you so much for recapping all the headlines there. Let's bring back in Gargi Chaudhary. She is Chief Investment Strategist and Portfolio Strategist at the Americas at BlackRock for her perspective on all of this. And Gargi, I guess one of the big things investors were looking forward to was a spate of deal making, the animal spirits unleashed with the new Trump administration. But as Joe made really clear, there's a lot of cross currents. And now with the tariff question still, unresolved, people and companies are afraid to move because they just don't know the operating environment. How much of a tailwind does that remove from the market?
Yeah, and I want to take us back to, if we can even remember, the time before April 2nd. So we think back to February and March. The markets were already selling off. We were already down 10% before Liberation Day, and that wasn't anything to do with these large reciprocal tariffs. A lot of it was just personal real disposable income slowing down. A lot of people had come into the year with the expectation of about a 1.5% GDP, and the recognition was that that number was perhaps going to be a little bit weaker. So I think now with the added pressure of higher prices, even if they are transitory, I think with the higher pressure of higher prices and goods inflation going up, I think it's just going to be a little bit more uncertain, i.e. volatile for some period of time. Now, if we see a deal come through with China, for example, if we see some headlines on taxes, for example, can we see a reprieve in the market? We obviously saw what happened yesterday when we see one positive headline. We can absolutely see that, and I think the positioning has been a little bit more cleaner today. But I think that broadly, we need to recognize that markets aren't cheap. And at the same time, yes, we've had a pullback, but at the same time, the forward is still a little bit more murky. We're not out of the woods yet, and therefore, add hedges. Don't move to cash, add hedges, add some minimum volatility, add some front end for fixed income. These are great opportunities to clip some coupon, but not take a lot of duration. And we think gold has, held up pretty well. That's another good one to hold in your portfolio.
It's so true. And also, what I was struck by what Joe was saying is that it's really hard for the arb traders to value a stock because you don't know what's in it. Like, what is macro, what is micro, and what is just straight up say just it's over-owned or oversold or whatever. How have you changed your models in the last 4 minutes?
You know, one of the things that I was talking with my team about is everyone's pointing to the PE and looking at how much of a, it used to be trading at 20 and now we're at 18 and now it's no longer at such a premium. But we don't know what the E is. No one sort of looking at any of that doesn't make as much sense. So I say, again, I'll repeat, add some diversifiers to your portfolio. Remain quite nimble because there are going to be opportunities. I think this is a trading environment. I don't think we're going to see the highs that we had seen earlier in February for some time as we begin to learn how to dissect the new news on growth, on inflation, and frankly, what that means on the Fed. We haven't even discussed that, and I think that's because it's less relevant these days. Yeah. And finally, I'd say just the huge moves in the bond market themselves has led to tighter financial conditions, which also have an impact on growth. So all of that, plus the destroyed wealth effect that has taken place, I think is going to weigh in on markets for some time.
And I'm sure the Fed is happy to be out of the spotlight for a while here because they're also trying to grapple with everything that's happening right now. In light of all this, you talk about diversifying your portfolio. What are the safe havens? Because treasuries have not proven to be much of a haven the last few days.
So we've been telling investors, look, if you think that the peak of uncertainty is behind us, and if you want to start sort of buying the dip, if you will, there are pockets that can work well for you. I think there are parts of tech, again, those that are a little bit more software focused that can work for you. But we think at this moment of time, defend and diversify. So defend with things like USMV, which is US minimum volatility strategies, which have a lot of staples and utilities and things that are, again, a little bit more defensive in nature. One area of the market that I think can continue to, again, defend, but yet has good earnings potential is actually healthcare. That's something that has held in okay, and we think that can, again, broadly be all right. Front end of fixed income, clip some coupon in a world where we're probably not going to see a positive number in your year-to-date return for S&P for some time. Clip some coupon, own some BINC in your portfolio that's giving you that income of about 6%. And then finally, diversify with gold.
Yeah, to Gargi's point, consumer staples up 0.5% right now, Alex, and you look at a name like United Health, gaining for a third day, up 3 to 3%.
Yep, I mean, there was fundamental news for that too, right? Because of the Medicare reimbursement, but still, nonetheless. Gargi, before we let you go, we were talking about sort of companies coming to the credit market and issuing debt today, so it was open a little bit, but spreads have really started to blow out in a way that we haven't seen in the last 6 months, right? When do you get worried?
So I won't use the term blowout quite yet. Yes, they've widened, but if you look at
relative basis,
relatively from where they've been, I don't think they're at worrying levels. Yes, high yield and IG have both widened, but if you look at where they were versus the average of where they've been from GFC to now, we're significantly below levels we had seen. So blowout, no. I think if we get to 150, 200 basis points wider than here, if high yields get back to levels that we had seen, high yield spreads get back to levels that we had seen in the pandemic, so 550-ish type levels, I think that could be something that people stop and get concerned about. But for right now, the starting fundamental point of credit is actually pretty strong. If you just look at the index, HYG, a lot more of it is BB rated than used to be about a decade ago. I think that's a good starting point. On top of that, for now, low default rates, maturity walls have been pushed out. Those are all okay signals, and there are buyers that like the all-in yield that 8% in high yield provides.
All right, we're about to start earnings season. The big banks kick things off tomorrow. What about earnings seasons could surprise us?
So I think we've all turned quite negative for all the right reasons. So I think if it's a blowout earnings seasons, I think the market will be very surprised by that. If all companies are coming in beating, I think that's going to be a surprise. I think if we're hearing nothing around profit margin squeeze, I think that could be a positive surprise, which the market needs at this point. On a negative side, I think if we start hearing about any kind of capex pushback or any kind of positioning around headcount readjustment, I think that could be something. And then another, obviously, a big negative surprise for the markets would be if many companies just push back on giving any guidance altogether. I don't think that's a good sign.
Well, I mean, we
Which
saw that
we
with Delta.
have seen. We saw that with a couple of companies
CarMax today.
this week. If that continues to happen, I think that becomes a little bit worrying.
I mean, I just don't know how you can possibly give guidance. This very much feels like that first quarter of the 2020 pandemic, right? Gargi, it was so great. Thank you so much for your time and for coming into the studio, Gargi Chowdhury, Chief Investment and Portfolio Strategist of the Americas over at BlackRock. So speaking of, you got the financials falling. KBW Bank Index is down by about 5%. It's not been a good couple days for the KBW Bank Index. We got JP Morgan, Morgan Stanley, and Wells Fargo reporting tomorrow. Here to discuss is David George, a senior bank analyst at Baird. Hey, David, I don't even know where to start, but let's try and dissect it this way. What would be a positive earnings result for the banks, considering it's all going to be about guidance?
Yeah, I was just going to say, Alex, good afternoon. I think the earnings are going to be, I would say, fine to good. The traditional business of banking has been fine. Loan growth has been a little slow, but would expect favorable net interest income trends and fees, particularly out of JP Morgan tomorrow, may be a little lighter from an outlook perspective. Trading, we think, is going to be pretty good, actually. So Q1 is going to be probably pretty good. Unfortunately, that's not going to give us a lot of answers. The game has kind of changed a little bit, Alex, in the last week since Liberation Day.
You think?
And there's going to be a lot of questions, obviously, around guidance. As you and your guest just were discussing, does guidance get pulled? We think there'll probably be, because 70% of the bank's P&L is net interest income, and I think you have pretty good line of sight around that. Credit and investment banking and more fee-centric businesses, I think, are a little bit more questionable at this point. So I think maybe you may see some companies consider giving a wider range of guidance based on a certain number of outcomes. But clearly, there's going to be a lot of questions. Jamie, tomorrow is going to be, I'm sure, a must-see TV, so to speak. So we're looking forward to seeing what we find out from the banks tomorrow.
Absolutely. I wonder how much of a better trading revenue picture we're going to get, because most of the volatility really happened in the last couple of days, and that's after the quarter ended. But how much of that will be reflected in the first quarter results, and how sustainable does that tend to be of volatility-induced record trading revenue?
Yeah, it's not particularly sustainable. Volatility is a very mean reverting statistic, right? So it's unusual that you have a 50 VIX, and it typically doesn't stay like this for a long period of time. But the volatility has been not only in equities, but in rates, so fixed income rates, currencies, commodities. So there's been a lot of movement in the first quarter. So we would expect the likes of B of A and JP Morgan to benefit from that. And it wouldn't surprise me, Alex, to see JP Morgan with that excess trading strength throw a little money in the reserve just to prepare for what is clearly now a more uncertain environment.
Well, to that point, I wonder if we can distinguish between banks that are more geared towards the capital markets versus banks that are more geared towards the consumer. Because first line of defense is going to be the capital markets just seize up and nothing happens, versus say what happens with the consumer, what happens with loan demand, what happens to net interest income. That's going to take a little longer to filter through.
I think that's right. I think you said it very well. On the fee side of things and capital markets, as I said, trading is going to be very good. Volatility clearly in April was quite high, so I would imagine that Q2 trading should be good. But M&A, which there, as you know, post-election, there's ironically was so much optimism around M&A, and to your point, I think that activity levels have ceased in M&A, and it's very logical. It's really hard to know kind of the rules of engagement and what profit margins in certain sectors are going to look like. So we would expect that to have an impact on M&A for the balance of this year, or at least the next 3 to 6 months. And then I think corporate loan demand is going to suffer a little bit as a result as well. Now, fortunately or unfortunately, the stocks are coming into earnings season, guys, with pretty low expectations. Yeah. We stressed the bank earnings for 2026 and assumed a 300% increase in losses, and we came up with not only the banks being profitable, but they trade around 9 times that adjusted earnings number. So just to kind of give you a sense as to how low expectations expectations are.
Yeah, high single digits there. So what are the growth areas, David, for banks? What will they want to talk about? And I bring this up because I saw that Chase, for instance, is offering 100,000 bonus points for people who sign up for its high-end Sapphire credit card.
Yeah, so in the case of Chase, they obviously, given their size, are unable to do a lot of M&A, but they really have been a leader, Scarlett, with respect to investing in the franchise, really throughout all of their major businesses, whether it's just a traditional retail bank, capital markets, asset management. They've been on the kind of leading edge as it relates to technology. So organic growth, I think, is going to be a focus for JP Morgan, but I think that's going to probably take a backseat to kind of what we're all talking about all day, all night as it relates to the markets and the kind of the implications of that.
Yeah, totally
I feel like we're probably in a 3 to 6 month period of just potentially, I would expect a shallow recession. And I would imagine that the commentary tomorrow about the macro is definitely going to turn a little more negative.
Silly question, David, but based on what you hear from earnings, how willing will you be to adjust your price target or your outlook, considering that things can change? Like we saw what happened yesterday, for example, with tariffs. Like what's your conviction level?
The lower the stocks go, the more conviction we have, Alex. We typically like to think about banks through on a normalized lens. And what I mean by that is, what is the normal earnings power for a bank? And that right now, banks are benefiting from abnormally low credit costs and potentially a little bit below normal net interest margin. So if you normalize everything, the banking sector is probably 7 to 8 times earnings. So it's not going to really change. A 3 to 6 month slowdown in capital markets activity isn't going to really change our outlook. Now, the credit side is, I think, a bigger wild card. And clearly there are going to be some segments of the economy, both in the corporate and the consumer sectors, that are going to have some challenges in the near term. Fortunately, the industry is very well capitalized and has got pretty significant earnings power to earn through higher credit costs. But that's going to be what we're focused on for sure.
All right, good stuff. David, really appreciate your joining us. David George is Senior Bank Analyst at Baird. And of course, we've got Wells Fargo reporting earnings tomorrow, along with JP Morgan Chase, and all eyes on the guidance that these executives are able to offer right now. Alex, we're looking at a market that is down, down, down. I mean, it really has not, we have not seen much of a relief, a sustained relief from the reprieve that President Trump gave yesterday when he put on hold most of the tariffs, except for China, which goes up to now 145%.
Yep, talking to Justin Wolfers on inflation coming up next, right after this. This is Bloomberg.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country, and how many people have another problem called illiteracy or illiteracy, right, which means they can read, but they don't choose to read? It's a challenge with the digital age because people they're reading on tablets, so we do count that as reading. If you have an e-book, you're reading the book, and I've been often asked if I'm listening to a book.
are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries as, and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president now how he wants to negotiate.
China has been fairly measured so far.
There's going to be stickiness to these tariffs.
Where is this leading to?
The state of the world is completely in flux.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case very quickly becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
It is just about 3:30 in New York. This is the countdown to the close. I'm Scarlett Foe.
And I'm Alex Steele. Taking a look at these markets here, we're well off the lows of the session, but we're still looking at a decline of over 3%. The VIX also, again, off the lows of the session, but still high at around 44, but we are not near that 50 level that we saw earlier.
I don't know what it says about the current environment that we both looked at the markets down almost 4%. It's kind of like, oh, okay, no big deal. Not that it's no big deal, but it feels relatively modest compared to what we saw in previous days.
Yeah, Scarlett had FOMO last Thursday, and I was like, there's going to be plenty of time to get involved with all of this. What's so staggering to me, though, is the difference that we're seeing in the bond market and the FX market. You're still having the 30-year up by 12 basis points. You're still seeing that sell-off in the dollar, despite stocks off the lows of the session. It kind of begs the question, like, what's leading what?
Right. The bond market, clearly, it was what the Trump administration was looking at yesterday, right before President Trump hit pause on most of the tariffs. You mentioned the dollar right now down 1.3%. That is not a normal move in the FX market.
It's not what you usually see for the world reserve currency. Also, we saw some economic data today, of course. That was CPI coming in a little lower than estimated. But tomorrow we get PPI, so we wanted to get a read on that with Michael McKee, economics editor with Bloomberg News and Bloomberg Television, economics editor and political. Your title changes every time I read it, so I don't know what's up with that. But all right, what did we learn from CPI? What did we learn from PPI tomorrow?
We didn't learn a lot from CPI. It was good news. Absent Donald Trump and the tariffs, it would have been seen as very good news by the markets because it would suggest the Fed is making significant progress on inflation. And now it's just sort of, well, nice, but we got to worry about what happens going forward. It was down 0.1% on the headline, which was good, but that was largely because gasoline prices went down 6.3%, which was largely because people were pricing in the idea of an economic slowdown. And we had the same thing happen with airline fares and with hotel charges. They went down for basically the same reason. So there wasn't a lot of information about what's going to happen going forward in this, but we may get a little more out of PPI because you remember all the imports we got in the last 2 months of industrial supplies and things like that. We'll see if there were any price changes as companies ordered massively to try to get ahead of the tariffs. But still, it's what's going to happen in the April and May inflation areas that's going to matter really to the Fed, which is what matters to the markets.
And clearly the CPI report didn't do much for markets today. You could argue that PPI might not do much tomorrow. The data point I'm really curious about tomorrow is going to be University of Michigan, because the consumer expectations on inflation has been pretty awful the last couple of times. And that's what everyone's fixated on, where consumers see inflation headed.
Well, you know, that's one of the things the Fed is fixated on, is they don't want to see inflation expectations get unmoored because then that feeds into future inflation. They tend to watch the shorter shorter end, 1 to 3 years, much more than the longer end. They're not sure that the long end view that people have is going to be particularly accurate unless it goes significantly higher for a while, and then it just shows that people are worried about inflation. But they will be watching the shorter end, and it's gone up significantly. We're like 5.1% now, and that would be a terrifying number to the Fed if it actually got there. But just the idea of it, and then we want to see what people are saying. We've said many times that what consumers say and what they do can be two different things. But we get retail sales next week, and maybe this gives us some view of what consumers are thinking.
Well, they've been, buying up all kinds of things before tariffs kick in, right? That's kind of.
I mean, that's the game theory, right? We'll see if we
all
see
the articles online are talking about what you should be buying now.
Okay, going to the Fed real quick before you let you go, Mike. We had a slew of Fed speakers over the last 48 hours. Has the tone changed? Has the focus changed? Is it more about inflation versus growth? Is it still equally distributed?
Well, it hasn't really changed over the last week, ever since Liberation Day, the so-called Liberation Day. Fed officials have been saying that we're going to see inflation from tariffs, and we are probably going to see an economic slowdown. We can't measure that yet because we don't know exactly what's going to happen, but we have to worry about both. They're a little more concerned about inflation because it's harder to deal with than a slowdown, and it will come on us faster than an economic slowdown. So their focus is a little bit more on that, but right now their focus over the last 24 hours was how the markets were functioning, and we talked to a number of them over the last 48 hours, and they basically think the markets are volatile, but functioning fine.
All right, Michael McKee, thank you so much. Chief Correspondent on International Economics and Policy, I think, has been one of his more recent titles, right?
Yeah, we'll go with that.
Just keep moving.
Just keep moving.
All right.
Call me on time for dinner. That's all I meant.
Mike McKee, thank you so much. All right, let's continue the conversation here on economics and policy and bring in Justin Wolfers, Professor of Economics and Public Policy at the University of Michigan. Justin, so good to speak with you. You heard what Mike was saying in terms of the setup here and the Fed focusing both on the inflation question and the growth question. Which are you more concerned with right now?
I mean, there's two great flavours coming right at us, courtesy of the White House. We've got fears about inflation getting reignited at exactly the same time that you might end up with the real economy slowing. So you should be scared of both. You should be worried about both. It's a very, very good time not to be Jay Powell because you can't fix both at the same time. So,
but based on that, though, is there a possibility that tariffs, okay, different question. How long does it take tariffs and that mentality to actually filter through to the hard data like CPI and PPI?
Right. So based on past experience, you'd probably expect it to take a few quarters, but equally, we haven't had a tariff shock like this in our lifetimes. This is a tariff shock larger than Smoot-Hawley, the famous Depression-era tariff. So it's very hard to get a lot of guidance from that. On that point, there's actually, I think, two economic crises right now. One is tariffs, and that's driven a lot of the market action. But I think one of the reasons you saw markets respond so strongly is there's a crisis of confidence. It's a crisis of confidence in the competence of the administration. They've rolled out tariffs based on formulae that make no economic sense. They stick with a plan where, they say it's all about one thing and then they roll it all back and then say, you know what, we've been lying to you since Sunday when I already decided to change parts. Tariffs on China yesterday, we were told, are 125%, and today they're 145%. And I want you to stick with that for just a moment. You've got tariffs between two of the world's great economic powers, and people in the White House couldn't tell you the correct tariff within 20 percentage points, which would normally be the entirety of an entire trade war. And they forgot whether it was 125 or 145.
Feels like the more important thing is just that it's a high number. It's a big number. It's a wow, eye-grabbing number, and that's what they want to go with to shock Xi Jinping to the negotiating table.
Look, if you want to shock the Chinese to the negotiating table, absolutely you've done that. By the way, you could probably just pick up the phone instead. But investors are looking at is the competence of this administration and how much they trust this economic team. It matters a whole heck of a lot. Look, I think this is a time where if I were on the economic team, and no part of me is joking right now, I would be checking everything for spelling mistakes, literally spelling mistakes, because right now they look like Keystone Cops. They look like they're making it up as they're going along. And if that's not the case, then they want to take every opportunity they can to signal competence. Instead, they've done the opposite.
Okay, so that's your take. And then what's the filter through to the actual economy? Or, I mean, is that what you think is unfolding now through the data and through the equity market?
So we're seeing equity markets move by extraordinary amounts, much more than could be based on than would make sense purely on the tariffs. So that's the sense in which I think the confidence crisis is here at the same time as the tariff crisis. Look, if you want me to back that up, I'm happy to math it out for you a little bit. We saw U.S. equities fall by 14% after Liberation Day. Markets had already surely priced in 2/3 of what Trump's plan ended up being, which means that the true effect must be 3 times larger. 3 times 14, what's that? 42%. It seems implausible that tariffs could take 42% off the net present value of future corporate profits. It must be the case that markets were responding to something else. What is it? It was a misguided policy that the administration was happy to double down and keep doubling down on. That's the only other shock that comes to mind.
Yeah, there's a lot of question marks there. And of course, the way that this whole tariff policy has unfolded raises a lot of uncomfortable questions and raises questions about the reputation and the credibility of this administration in negotiating some of these tariffs, which it apparently is actively doing right now. Talk a little bit about how much we can then rely on what happened in the first Trump administration. I know that up until yesterday, we were saying you can't use Trump 1.0 as a template for Trump 2.0, but apparently you can because he is willing to negotiate now. The renegotiating of NAFTA into the USMCA, does that kind of serve as a template for what we can look for when it comes to tariffs for Canada and Mexico?
I think that template matters for 2 very important reasons. So Trump arrived, had a free trade agreement with Canada, said it was terrible, ripped it up, wrote a new one. That's what he did in the first term. By the way, turns up, arrives in the second term, has the same agreement he negotiated, rips it up, says he's open to creating a new one. So that says he likes ripping up agreements. So that says something about the credibility of any promises the United States makes in this round of renegotiation. Look, everyone's going to play ball with him. They're just not going to go home and believe that he's going to follow through. And if you don't believe that, then you're not going to make the appropriate investments around that, which means we're going to get the costs of tariffs, but not the benefits. Having said that, Scarlett, let me come back. I actually think what you just said is really, really smart and exactly on the money. So here's how the first administration played out. NAFTA created essentially free trade between the United States and Canada, as well as Mexico. There were a few carve-outs for politically sensitive industries, so it was essentially zero, but not precisely zero. Trump arrives, points at the few cases where tariffs aren't zero, gets very upset, rips up the agreement, starts a trade war, and then says, I'm open for negotiation. Negotiates, and then decides to basically write down the same agreement because, well, zero tariffs was pretty good 6 months ago. It's still pretty good. The politically sensitive stuff is still really hard to do. So we end up with NAFTA, they get out the pencil eraser and relabel it, give it a new name, and he struts out and calls it the art of the deal. Well, what we have is Europe and most of our other trading partners already have very, very low tariffs on average, 1 or 2%. Don't believe the numbers the White House are telling you. They're not telling you anything about average tariff rates. We essentially have free trade around most of the world. He's ripped up those agreements. In some cases, they're not agreements. They're just countries doing what they want to do. Summons them to Washington, D.C. Very quickly, he's going to discover you can't get tariffs below 0%. So if they're nearly 0%, you can't negotiate something much better. Of course, he'll negotiate something close to 0%. It's pretty much where we already are. Slap his name on it, march out to the front lawn of the White House and say, look at me, art of the deal. I got tariffs, say, with Vietnam, close to 0. I just want your viewers to understand they're already close to 0. So this whole shebang can't move us very much in a positive direction because global trade is still, before this week, mostly tariff-free.
Justin, just to push on that for a second, how would then you categorize China, for example? I mean, clearly there are trade imbalances, right? Like, I mean, we've heard this from both sides of the aisle, right? So doesn't there need to be something fixed there?
Alex, there are real problems with China, but saying there's a trade imbalance is not one of them.
Why not?
That just means we buy more of their stuff than they buy of ours. That's all that says. Look, there are real issues with China. Issues like intellectual property is, I think, probably one of the most important ones. And so I said most of the world, but it's still the case that most of our trade with China, if you go back a couple of months, was at pretty close to no tariffs. There are issues with China, some of them geopolitical. Those would call for a very specific tariff response. That's not what we're seeing. You don't put a 47% tariff on Vietnam because you want to bring China to the table to talk about intellectual property. So, yes, there's a serious way forward. There's also questions of China's influence in the region. The White House recently has been saying what we need to do is get countries in the region together so that they can talk to China collectively from a position of strength. That's something that was once called the Trans-Pacific Partnership.
Yeah. Yep.
We had that agreement. He ripped it up. He's going to rediscover it, and hopefully we'll actually move forward with it this time.
All right, Justin, we'll get you back. Want to talk about break-evens, too, because they've been moving, so we'll put on your economics hat next time. All right, Justin Wolfers, professor of economics and public policy at the University of Michigan. All right, time now for top calls. A look at some of the big movers on the back of analyst recommendations. First up, Adidas getting a big upgrade from HSBC to buy from Hold. The broker says the company's market share gains could accelerate during a time where macro conditions are tough, calling the sportswear brand a beacon of hope compared to other competitors like Nike and Puma. HSBC did cut its price target at 240 euros from 260. Shares, though, still down by about 3%, Scar.
All right, I'm looking at GM, which got a downgrade at UBS to neutral from buy. The bank citing the possibility of tariffs raising prices and disrupting production, saying, quote, we see potential for a new era for U.S. autos with lower volumes and higher costs to produce. GM's price target also reduced to $51 from $64. You can see the shares down about 4.8%, and for the year, lower by about 15%, Alex.
Let's stay with autos for a moment. Ford getting a downgrade at Goldman Sachs on similar concerns, also cutting its recommendation to neutral from buy. Goldman lowering its outlook for U.S. auto sales and global production. Goldman currently has a price target now of $9 on the stock. We're trading pretty much right there. Those shares down almost 5%. And those are some of our top calls. Scarlett.
All right, let's stay with the auto sector. We're keeping an eye on CarMax. The used car retailer did report quarterly results that missed several Wall Street estimates, with management also pulling several financial target timelines on trade volatility. CarMax joins a growing list of companies indicating uncertainty around President Trump's trade war. Here with more context is Seth Basham, Managing Director of Equity Research over at Wedbush Securities. Seth has an outperform rating on the stock and a price target of $100. Looking at CarMax today, lower by about 13%, the biggest drop since September of 2022. It didn't exactly pull its guidance. It just said it's not committed to the time frame for the financial goals, right?
That's exactly right. The guidance is still in place. The company will hit those targets at some point. It just doesn't know when. So it's likely to be later than fiscal 2029, which was the high end of its prior range.
So why did the stock get dinged so much?
Yes.
Yeah, we're surprised at the extent of the decline today. I think that was one reason that investors are misinterpreting the company's ability to hit that target at any point in the future. So that's one. The second is their comparable store unit sales for the fiscal fourth quarter they reported were a little bit light of consensus forecasts. And then the third is associated with the near-term uncertainty. So it's not clear how well the used car market will do and how well CarMax will do in this very volatile macro.
But there's this narrative, certainly when the auto tariffs were being discussed, that this was going to be good news for used cars because people wouldn't be able to afford to buy new cars, so there's going to be this bustling market for used cars, and everyone was going to flock to go to a CarMax, for instance. Where did that narrative go wrong?
The narrative went wrong is that we're seeing a slowing economy at the same time. Consumer confidence is declining, so consumers' ability and willingness to buy used cars, especially late model used cars that are expensive, $30,000 plus, is not there. So we very well could see a slowdown in used car sales because of that, partially offset by the trade down from new to used.
Okay, yeah, I was going to say flip it, because you can also make an argument that like a GM and Ford are going to make more expensive cars and not make as many of them. So if I wanted to buy a cheaper car, I'm going to have to buy a used one, which in theory then could be good for CarMax. When do we get that kind of clarity?
We're going to have to get that clarity in another quarter or two. So right now, I think we're seeing strong sales of both new and used cars. There are more car shoppers out there, some who are going to buy new cars ahead of the tariffs. They get into the marketplace, still end up choosing used over new, which is positive. We expect that to continue for at least the next week or two. As we move into the summer, I think it'll be telling whether or not we see that trade down offset any economic weakness.
So the company says that it's seeing a lot of interest in used cars right now, given the expected impact of tariffs. How does CarMax really take advantage of this opportunity right now? How does it maximize this situation?
Well, it sells as many cars as it possibly can. And that means it has to acquire the vehicles, recondition them, get them ready for sale, merchandise them, et cetera. So we think their comparable store unit sales are very strong right now. They'll be able to press on that for the next couple months.
So to that point, do their input costs also rise if they have to get something up to spruce up a car, or no?
Modestly.
Or it's manageable?
Modestly.
Okay.
We're talking a very small amount, maybe $100, $200 in terms of higher part prices that they'll be experiencing. But on a $25,000 ASP, not a big deal.
Right, not like a $15,000 increase on a new car that you might have to pay.
Exactly.
Yeah.
So you have a price target of $100 on the stock that's currently at 67. What needs to happen for there to be a jump condition to get even in the neighborhood of that?
I think we need to see more consistent, strong comparable store unit sales and great flow through to the bottom line. This is a company that's invested heavily over the last 6 years in omni-channel, and it has the best experience out there for consumers shopping for used cars. So it delivers on that experience. We should see strong sales, we should see strong flow through, and we should see earnings help drive the stock to those higher levels.
What other stocks in this arena do you like?
The other used car retailer I follow is Carvana, which also has a great market, but we're more favorable on CarMax at this point in time. We also like the auto parts retailers like AutoZone.
Or O'Reilly, for instance. Okay, are there any of those that are not positioned well for this current environment?
In terms of the auto parts retailers, they're very well positioned for the macro uncertainty, and they have very good pricing power. So I would put them on the list of well positioned. In terms of the hard lines retailers that I cover, the ones that are least well positioned are names like Best Buy, who get most of their products from China, are selling to a mass market, so they don't have much pricing power of highly discretionary products they're selling.
Yeah, I was just looking at the all the companies that you cover, and that is definitely a wide array in terms of consumer. Like you have RH, and then you got Chewy, and then you got the Best Buy and AutoZone, and then also Lowe's. When do you think we're going to get clarity on the consumer for the names that you cover? As in, when you're listening to all of these earnings calls that are going to come up in the next 4 weeks, what's going to be the buzzword you're looking for?
Well, near-term sales will definitely be a key focus. Obviously, Walmart yesterday talked favorably. We're seeing some of that pull forward potentially because of tariffs, so we're not going to have clarity on sales trends for another month or two, in my view. So I think it's going to be really 2 months before we have really good clarity on how the consumer is responding to all this.
All right, Seth, thanks a lot. We really appreciate it. It's great to have you here. Seth Basham, Managing Director of Equity Research over at Wedbush Securities. Just some breaking news for you. There has been a helicopter crash in the Hudson River. This is according to the FDNY. You're looking at a live shot now, Scarlett.
Yeah, it's crashed in the Hudson River on the west side of Manhattan. It occurred in the vicinity of the West Side Highway and Spring Street, according to the NYPD, which posted this on social media. We will continue to monitor these headlines and let you know if we learn of any new developments.
Yep. All right, let's go back to the markets here. We are about 10 minutes away from the closing bell on a pretty brutal day. S&P is down 4%. We are off the lows, but we are rolling over as we head into the close here. You're also looking at tech down, Magnificent 7 down over 5% as well. Scarlett, one of the worst performing sectors in the S&P, though, continues to be energy, when you had oil closing at a 4-month low. Also the semis, that stocks index low as well. It's really chip stocks and big tech and energy are leading the way lower now for the S&P.
Autos as well. If you look at the S&P 500 on a 24-sector basis, there are 3 groups actually in the black. Household and personal products, food and staple, and telecom services, your classic defensive sectors, Alex, that tend to do well, that people flock to as their safe haven. They have steady dividends. They'll continue to do business, even in a difficult economic environment, and they are now the havens of choice at the moment.
Yep, taking a look at that as well. The big question, though, becomes what happens with the dollar, really whippy action. The front end as well. The back end of the Treasury market, that 30-year still struggling. The 10-year yield is up by about 6 basis points. For more on that, let's welcome Steve Sosnick, Chief Strategist over at Interactive Brokers. Steve, it's always good to see you. All right, what's your biggest takeaway right now? Like, volatility still up but off the highs. S&P still down off the lows. What's my takeaway today?
Couple of them. Volatility begets volatility. If you and I thought we would be sitting here with the S&P's down 4% and VIX at about 47 and sort of having a calm conversation, this just shows you how inured we've gotten to it,
So
right?
true. And just in like 5 days.
It's been a week since this tariff, since Liberation Day. It was Thursday, a week ago. Today was the first day we had to react to it. So this is like a year's worth of volatility compressed into a week. That's really one of the big takeaways.
And there's more to come as well, because we haven't really resolved anything. One thing that did become apparent yesterday is that there is a Trump put, isn't there?
You know what? If there wasn't a Trump put, it was awfully something that looked an awful lot like it. We were wondering when it was going to show up because, really he'd been sort of, we'd been led to think that he was, at least from the first administration, that he was going to keep an eye on the stock market. Then we were told, no, we're not watching it. No, it's all about bonds. I think the put, in all these cases, though, I do think it's about the bond market.
Yeah, but I wasn't say the put's the bond market. It's the long end of the bond market.
Well, it's certainly the Fed put. Anybody who's an equity person who talks about the Fed put, I think they're a little bit delusional because that's hubris, because the Fed is watching the bond market and liquidity. But I think the Trump put was also the bond market, and part of it had to do with, I think, this is the realization that could be one of China's way of fighting back against some of the tariffs is go on strike about, we buy stuff from them, they buy bonds from us.
Right. A lot of talk about perhaps China and other strategic buyers of treasuries holding off and saying, we don't need to do this. That being the case, do you think the Fed was close to jumping in or intervening in any way because of what they saw as perhaps illiquidity in the treasury market?
I can't answer that because I don't know what was going on in terms of their mindset. In terms of the reasons why people might expect them to jump in, they can't really do it because prices are not going down. There's no real crisis in the labor economy, so there's your dual mandate right there. Neither one of them is saying it. The third leg of the dual mandate is keep the system running, but I can't gauge how bad things were or were not because there were some contraindications that maybe this was just people positioning ahead of the auction. So
yeah, exactly.
They're not going to intervene on that.
Okay, let's get to retail traders because JP Morgan had a note out that said that the retail guys were buying shares in recent days as institutional investors and hedge funds dumped equities, and they're now cost-wise almost break even for the year. Are you noticing that? Like, are we still seeing buy the dip in some portions of the market?
Our customers never stopped buying.
You're kidding.
Never.
Why? What was the rationale behind that?
I think it's just people have been conditioned to buy every dip. Remember, a lot of this has been, with the exception of most of 2022, buying the dip has worked really, really well. For certainly for the last 2 years, every dip appeared to be a buying opportunity. Now, it's tough to know when buying the dip becomes catching a falling knife, Alex. But what we've seen here is, I look at our 25 most active names, and pretty much consistently 22 through 25 of them have been consistently on seeing more buy activity than sell activity. It's the usual suspects, Nvidia, Tesla, but also our customers have been very active in leveraged ETFs.
Single stock names or sector specific?
Both. TQQQ was, I think, the third most active name on our platform through last week, but also TSLL, but SOXL, which is telling you that our customers, in the most volatile of environments, they're going for more volatility.
Amazing. Talk to me about funds. What are you seeing for funds? CTAs, commodity trading advisors. You also have volatility trading funds. They have to rebalance really quickly when we get these whippy moves, right?
Yes.
What have you noticed from that?
It's tough. We don't break out the activity that way, so it's a little tricky for me to parse it out. I do think some of the aspects about, risk factor, the funds that do that manage the risk factor, there's a little bit of what I would call negative gamma type of trading in there, meaning you're sort of forced to sell low and buy high to stay in touch with your volatility targets. I do think that made things a bit worse and sort of added to the crisis. The ultimate, my first real experience in the market was the crash of '87. I happened to be relatively new on the desk then, and that was the ultimate let's sell into a declining market strategy. As an option trader many years, you always want to be avoiding a situation where you're forced to sell into a down market and buy into an up market, and I do think that there's a lot of that, what we've seen from very strategic type of funds that mechanically rebalance.
Never a dull moment. We look at the S&P 500 down about 3.3% with about 3 minutes to go in trading. And of course, the news keeps going because tomorrow we get the start of earnings season. What are you looking for from the banks? I know that they're, of course, leveraged to interest rates, and they give us a read on that. But what will you be taking away from those results that inform what the rest of earnings season might look like?
I'm going to be listening for the conference calls because I used to basically specialize in trading bank stock options, and I hated that banks went first because they're so fluky. No one else has trading revenues that matter. No one else has that leverage to the interest rate cycle. So you can't take away the rest of earnings season from if Goldman Sachs had a good quarter in equities and commodities. It doesn't translate. But what does translate is what is Jamie Dimon going to say? What is Brian Moynihan going to say? Jane Fraser, et cetera,
yeah.
Because they have great visibility into what customers large and small are doing.
Fluky, I love it. Steve, awesome stuff. Steve Sosnick, one of the best chief strategists at Interactive Brokers. Great to get that perspective. All right, we're just about a couple minutes to the closing bell. We got full market coverage for you here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Alex Steele alongside Scarlett Fu going to take you through the closing bell on a global simulcast. We're joined now by Bonnie Quinn, Carol Masser, and Tim Stenovic, bringing together our Bloomberg Television, radio, and YouTube audiences worldwide. We're going to parse through the crucial moments of the trading day, which is pretty much every single moment. We are off the lows, but we're still looking at S&P down 3.3%.
Yeah, exactly, right? Lots of volatility once again. Very different tone from what we got yesterday. We are, as you said, Alex, I think it's important that we did see a bounce off the lows. We'll see what happens in these final minute and a half or so of trading. But you are seeing broad-based selling. Most names in the S&P lower here.
We just had a really sobering conversation with Rich Weiss at American Century Investments. He's not buying the dip. He said it's like catching a falling knife. Vonnie, he says this downturn is more serious than the other ones. He called this a man-made catastrophe.
And by the others, he means the great financial crisis or COVID. I mean, this is what he's saying the environment is.
Yeah, I mean, Ben Emmons calling it this morning a yippee-ki-yay market, and it really does feel like the Wild West out there. We haven't had any circuit breakers triggered, but we certainly have had moves of more than 5%, 6% in some cases, and we may not be done. Bloomberg's Matt Levine saying this is a buy the truth, sell the news moment. So what is the truth? The truth is that there are plenty of tariffs, and they have been put into effect.
Well, the truth is nobody knows what's going to happen, and the data will be backwards looking, although we do get the University of Michigan Consumer Sentiment report tomorrow, and inflation expectations on a one-year basis. That'll be critical because that's a lifetime read, although it is based on what people say, not what they do.
I love me that you mish. I should point out, guys, we just talked to Steve Sosnick, and he was saying that retail clients are still buying that dip. That conditioning still stays. There we go, the closing bells on this Thursday. You're looking at declines for the S&P coming in around 3.5%, the NASDAQ around 4.5%, the Dow off 2.5%. I should point out, if you take a look at the S&P, the NASDAQ 100, the NASDAQ, the MAG 7, they all fell the most at 1 point today, since the most since 2020.
All right, to the S&P 500 I go, guys. 428 names to the downside on this Thursday, 74 to the upside. Scarlett, 1 unchanged.
All right, let's take a look at the IMAP, which shows you the different sectors in the S&P 500. Basically a sea of red, although you can see that consumer staples did finish the day just marginally higher. Yeah, by 0.2%, and that's thanks to the likes of Kroger, Church & Dwight, Colgate, and Kimberly-Clark. So classic defensive consumer staples, companies that will be around, that will continue to do business even in a tough economic environment.
All right, that's a lot of red. I was terrified to find gainers today that they would hold, but
I
got a few.
You did it.
Kroger up 3%, guys. The consumer staples.
You got 4. That's what we call an overachiever.
I was. Consumer staples, I think as a whole, I think they finally blipped into the green a little bit overall, but nonetheless, we saw some pressure on that group. But Kroger, among the names that did actually show some gains, up about 3%. Gold, right? Mining stocks advancing today. Bullion prices climbing to a fresh record. And so you saw investors moving into this. A safe haven, right? Gold. And so you saw Newmont among the gainers, up about 4.5% in today's session. This one's up about 35% year to date. Here's a biotech company, folks. Keros Therapeutics up about 18.5%. This is after initiating a review to evaluate strategic alternatives. They're also thinking about a potential sale. It's based in Massachusetts. It also adopted a shareholder rights plan in response to, quote, significant and rapid accumulations of the company stock by investors who have indicated a desire to influence the control of the company. So this one was an outperformer. And for, yep, here I go, PriceSmart. I've never heard of it. It's up 7% today. This is a $2.7 billion market cap and operator of warehouse clubs in Latin America, and they reported second quarter earnings per share that beat estimates. So that's where investors were hiding today.
You got to travel abroad to find those gainers,
so.
Carol. Easy job that I had. In fact, I picked a couple indexes because there were so many stocks lower.
Embarrassment of riches.
It really was. I want to start with the Mag 7, down 5%, dragging down indexes a day after posting its best day ever. Yesterday, it rose 15%. Today, it fell as much as 8%, but it settled in lower by 5%. Tesla, Meta, NVIDIA, and everything else in the Mag 7 were lower. And have you guys talked about what happened to CarMax today? Shares falling 17%. This after the company said it's removing timelines from its financial goals due to uncertainty around President Trump's trade war and broader macro factors. They are, though, seeing increased demand for used cars, and prices are going up for them due to expected tariff impacts, though they're facing rising costs for parts, and they're looking at mitigation plans as well. Also, keep an eye on shares of Disney. Disney fell by, let's go ahead and round that up to 6.9% today. This after we learned that China will reduce the number of imported U.S. films and introduce more films from other countries. That's according to a government statement. Disney got about 10% of its revenue from the Asia-Pacific region in 2024. That's how it breaks it down. The president was asked about this news from China earlier today at his cabinet meeting. His answer to the question was, quote, I think I've heard of worse things. He did not elaborate beyond that. And finally, semiconductor stocks getting beat up today. This after they were up 19% yesterday. The stocks fell 8% today. Everything was in the red.
An interesting one as well was the 30-year auction. We were all waiting for that at 1 o'clock to see if there would be a bid, and there was no buyer's strike. It was good news for that auction. Pretty strong demand, although if you're looking for any kind of a directional signal, the bid didn't hold quite so well as yesterday's auction after the auction. So we had the 30-year rise about 4 more basis points after that auction to finish the session now at 486.51. I will point out, though, that the 2-year went in the opposite direction, down 6 basis points, 384.33, right in the midpoint of its 2-day range, if you like, because we have seen a 40 basis point round trip for the 2-year yield, but it's in the midpoint there, and that was after the CPI data salved some egos out there.
Yeah, and I should point out, too, that 30-year moved 54 basis points in 5 trading days. You had that 5-10 spread really steepening out, the highest, the widest, I should say, since 2021. And my question is, until bonds calm down, can stocks calm down?
Probably not, right? And so this is why I guess our shift begins now. Earnings, right? Bake earnings tomorrow. And I'm looking at the KBW Bank Index down another, 5% in today's session after a 9% rally yesterday. Very different tone. But what we get on those earnings call, nobody cares about the quarter that was. Everybody cares about the outlook. What do we get in terms of commentary? And on that, I'm going to bring you in, Tim, because we just had a great conversation with Sri Natarajan and Max Abelson. There's a great story on the terminal about a JP Morgan analyst kind of holding back in a conference call, a presentation, because concerned about maybe saying certain things that might get the attention of the White House. Yeah, this story getting a lot of attention. The strategist has been lauded by Jamie Dimon as one of our firm's great thinkers, and he's taken this unusual step to highlight fears on Wall Street over speaking out against the Trump administration. To that point, Max and Sri also telling us loan loss provisions and any commentary on how these banks tomorrow are thinking about this current quarter, given the impact of tariffs, how they view consumers, and how they're doing. Remember, it's JP Morgan, Wells Fargo, and Morgan Stanley that are reporting tomorrow morning.
Thank you for the reminder. Going back to that.
I sense like you know this already, Scarlett.
Going back
it's
to
like
that,
the moment we've all been waiting for.
Exactly. Going back to that story, though, that you mentioned about JP Morgan strategists being careful about what they're saying, it kind of shows us how the U.S. is starting to, I don't know, in some ways behave like an emerging market. And you see this in the way that people are being extra careful in what they say and how they say things, as opposed to a developed market.
Yeah, I mean, it's going to be interesting to see the price action tomorrow, right? Because we have another day's trading, and we've had such a whippy week and so many differing things out there. And don't forget, there may be another China response later on this evening. China just getting up to start their day. They're meeting with some of their products with a 145% tariff upon them. What's the response going to be? A further weakening of the yuan?
Well, you have to also wonder, too, what the tape is going to look like for these banks, guys, which I'm really curious about, right? I mean, we saw Delta rally despite pulling guidance because we had an up tape, and then you saw CarMax saying that their targets might not be hit in their time frame, and you saw it get pummeled. So I think how we set up the tape will be really interesting as well.
I agree, right? How investors read into it, or whether they're like, I don't care. All I care about is what I'm getting in terms of tariffs and what the future looks like in terms of a trade war. Do we have one? Do we have one that lasts for a long time? Do we have one that just lasts for a little bit of time?
Well, I think key is to watch what happens in China. I mean, if you just look at the tariffs, each and every day, we're seeing more tariffs imposed by this administration on China, up to 145% from 125% just earlier this week.
Yeah, well, that number can still increase because it went from 125 to 145 today. It's kind of clear that there are a lot of tariff threats issued over the last couple of days, and in adding it up, it's hard for us to understand where we're at because it's a moving target.
And what I'm curious about is, does China and Europe try to strengthen their alliance? It certainly seems like the PR messaging out there from China, at least, is that it's, making definite advances to Europe and offering things to Europe and asking Europe for help. Will Europe, decide to help China, to the detriment of the United States, or, does that get nipped in the bud pretty soon?
Gotta say, I was sick on Monday, and it feels like this has been a month this week.
Oh my gosh, totally.
Crazy, crazy. All right, guys, that's a wrap. Our cross-platform coverage on radio, TV, YouTube, Bloomberg Originals. We call it the closing bell, and we will see you all tomorrow.
And let's have a look at where markets finished the day, because we did have another down day, although we were off our session lows at the end of the day. For the most part, the S&P 500 down 3.5%, 52.68. So we're still well off the lows that we have seen this week. The Nasdaq Composite Index down 4.3%, the Nasdaq 100 down 4.2%. If you look at the 10-year yield, it was up 6 basis points. That's kind of a middling picture of where we were, because we had the 2-year yield down 6 basis points and the 30-year yield after that auction up a whopping 11 to 12 basis points. Gold at a record, basically. We hit an intraday record earlier of 3,176.14. We're just a couple of bucks off that. And that's interesting because correlations had been really at 1. We had seen almost all asset classes move together, from Bitcoin to bonds to stocks. Perhaps now we're seeing a little bit of settling in the market, and some of those safe haven assets might become safe haven assets again.
All right, well, let's take a look at some individual movers. I wanted to start with CarMax, mainly because as a used car retailer, it certainly is affected by the various tariffs that have been threatened and imposed. The CarMax down 17% on the day after it removed timelines for its full year guidance. Even though it says it sees increased demand for used cars, it can no longer stand by its original timeline for those financial goals. So not exactly withdrawing its guidance, but certainly making some adjustments for the timing of being able to achieve its guidance. United Health, the massive health insurer, up almost 3%. In fact, gaining for a third straight day. And certainly this is part of the flight to safe haven, but also the White House's 5.06% pay increase for Medicare Advantage plans from United Health and its rival Humana does remove an overhang for the industry after some recent reductions. So perhaps a little bit of relief there for UNH and Humana. All right, let's talk a little bit more about the broader market overall and just kind of take stock of where things stand when it comes to price action this week. Bloomberg's Michael Ball joins us now. He's a market strategist for us, and of course, he's had a career working at the New York Fed as well as some other places. Michael, good to speak with you.
Thanks for having me.
In retrospect, when we look at what's happened, yesterday there was this massive rally. A lot of it was short covering. Have the shorts been squeezed out? Where do we stand in terms of positioning, do you think?
Yeah, that's a great question, because I think more shorts were put on today. You saw everyone that rallied yesterday basically underperform today. So the macro narrative hasn't really changed to give anyone reason to have a longer-term view change.
It's interesting because TD Securities said earlier that CTAs continue to hold that short position, as you're saying now, that there is a big short out there, or at least not the big short, but maybe quite a sizable short, but that they'll only abandon those short positions above 5,900. We're not above 5,900 today.
No, we look like we're wedged between 5,500 and 5,000. So it may be a volatile, choppy range for a while until we get further clarity on the China-U.S. relationship.
What assets are you going to be looking at? What asset classes? I know the bond market, obviously, because it's like the tail that wags the dog here.
Yeah, I think the steepener makes sense because the front end still works, but obviously there's worries about support in the back. I think gold will work too because the dollar is obviously under pressure as well. So it's tough to know, but equities will probably be even a rotation further into defensives.
Okay, so the staples that we've seen rising, we can continue to see some strength in those.
Potentially. I think as you guys have hit, the earnings season is going to be really the key, and whether the guidance is more uncertain is where everyone will be looking.
All right, well, you've got a couple of hours of a lull now, Michael, before it all gets going again.
It's
One
been
more
something
day.
else.
That is Michael Ball here with us from Bloomberg, and do follow his writings on Bloomberg T-Live.
You can check it out on MLive Go as well as T-Live Go. All right, Bridgewater Associates founder Ray Dalio weighing in on Trump's tariffs. He says the turmoil is hurting the U.S.'s reputation and we could see a recession. Take a listen.
I think it's likely that we're going to be in a recession. And the question really, recession is, a line at zero you get, and then, sort of 2 quarters in that. And I think right now it's close call and it's probable.
All right, here now to discuss all of that is Peter Tchir. He is head of macro strategy at Academy Securities. Peter, if nothing has been made clear, it is the fact that the economy has taken a hit, certainly perception-wise, even if most of the tariffs have been rolled back. This idea of recession, where are we with that? I keep hearing shallow recession as kind of the default scenario.
I think I've already moved to recession with a capital R. I think it's going to be deeper. I think the friction that's going on globally is going to cause a global recession, and we're not going to be spared. At the same time, right, we're cutting government spending, which I think is necessary. We've got to get the deficit down, but we've been reliant on government spending for the economy. So I think that's a hiccup here. The trade war, and I think we're close actually to upgrading the trade war to almost calling it an economic war with China. When we look at the DIME framework of diplomacy, information, military, and economic. This feels with China, this is growing beyond a trade war and runs the risk of being an economic war, which I think will be problematic for global markets.
Problematic for global markets, problematic for investors as well. What are you hearing from your clients at Academy Securities? What are they saying in terms of how they can position themselves for the next 90 days?
I think everyone's just trying to stay awake at this point. It's been insanely busy. It's I mentioned one client. Feels like we're going through a TARP vote every single day, and the client pointed out at least TARP was scheduled. We're going through this crazy market. I think people are tired, but I think it's starting to sink in that there is so much uncertainty out there that people aren't going to spend money, that corporations aren't going to spend money, and I think that's the risk that's starting to settle in. Right? Yesterday we rallied off the back of, and I think it was good. Like, let's delay, let's see what we can negotiate, but that still leaves a lot of uncertainty out there. The global economy is under pressure. I think companies have still not priced this in. Investors still haven't fully priced this in. I think we get back to the lows, and I think we can be down maybe 30% from absolute peak. So we got down 20%. I think there's room for that to go through, and we'll bounce once in a while on these, positive headlines. But if we're really convinced that we have to have this economic friction, it's going to be painful. And I think Xi is quite prepared to go the distance with this, as is Trump. So I don't know what the off-ramp is right now.
Yeah, I mean, that's what I was going to ask, Peter. What is the best case scenario here? Even if we leave China aside, it's its own thing, it's its own set of negotiations. What else do we have? A bevy of bilateral agreements at some point? What does that do for the market, or for corporate America for that matter?
Well, we've been thinking a lot about what these bilateral agreements might look like, and I think tariffs will only be a part of it, is my concern, right? I think tariffs are relatively easy to negotiate. I don't think tariff barriers are the biggest problem to trade. I think, really the 10% tariff Europe has on us on autos, is that really what drives U.S. auto sales in Europe? I don't think so. But my concern is that Trump, who is very, very focused on trade imbalances, may require quotas of purchases of U.S. goods. That might make these tariff negotiations harder. And he may also try and include language that restricts how much trade you can do with China, right? China was able to get around some of the earlier tariffs by setting up in Mexico, by doing things through Vietnam and other countries in Southeast Asia. So I think these negotiations won't just be about tariffs. They will try and incorporate something about quotas to get the trade balance, and may even have things that restrict what countries can do with China. So I think that's going to be far more difficult to do. And if China gets a whiff of that, and it's coming true, then it can get derailed. So hopefully it's just about tariffs. I think that would be simple and easy, and we can move on. I suspect it's not, because I don't see how you solve the problem of China trying to use alternate countries to get their products in here if you don't try and clamp down on it.
Peter, is there any scenario in which Europe at least messages that it's cooperating in some way with China? That seems to be one of the only ways that you might be able to turn the screws on President Donald Trump.
Yeah, and I think that's why he's going to try and push back in these deals he offers. I think we'll have some sort of restrictions on, what you can do with China. That's why I think this gets worse probably before it gets better, as everyone really has to figure out. I think China and Trump may make every country pick a side. Who's more important to you? I don't know that will happen, but kind of from the messaging, this goes well beyond tariffs now, right? This is about trade. This is about Trump wanting to rebuild the middle class. He wants manufacturing here, and I think he will push very hard to get that. So I don't know what an obvious solution is, and I don't think China will take this lightly either. What will they do to kind of try and force trade to them? Yet to be seen. I think they're going to use a lot of their own tariff sort of diplomacy. I think they may look at Taiwan and say, what can we do in terms of one country, quote unquote, two systems, to maybe impose duties? Because that is one real weakness the U.S. faces, is critical minerals, rare earths from China, but also all our AI chips are coming from Taiwan right now. That's right in China's sphere of influence. We don't think they'll do anything aggressive militarily. That's not something, we work with 30 generals at Academy Securities. We don't see military imminent, but we do see gray zone type activity and the potential to use tariffs or other sort of economic levers to fight the U.S.
And one of the economic levers that China has at its disposal is perhaps to sell U.S. treasuries. There was some worry about that, and that might be why treasury yields continue to climb, especially at the long end of the curve. Peter, why was the 30-year auction, which met fairly strong demand, not providing relief to the market today?
It's two small events, and I think it was good. We had pretty solid, what looks like indirect bidding, which typically means foreigners. But again, I don't think that solves the issue of where we're headed. If we're not going to generate all this tariff revenue, where do we, how do we fight the deficit? We've now talked about upping military spending from $800 billion to $1 trillion, which I think would be really good and really interesting, and will let the military get a lot of new equipment. Having said that, that's not good for the deficit. So maybe they're starting to creep in some doubt about our ability to decrease the deficit, that the trade war is going to be inflationary, that it's going to put pressure on the U.S. economy, it's going to restrict what the Fed can do. So I think all those things are coming to play, and I do think a lot of countries, and not just countries themselves, but I think pension funds within those countries are going to be reducing their exposure to U.S. treasuries in particular, but U.S. assets, including corporate bonds. Two things that, the Mar-a-Lago Accord has some vague reference to, maybe countries will be forced to turn their treasury bonds into zero coupon perpetual bonds. Yeah, I don't know if anyone took that serious 2 weeks ago. Given what we've seen in the last week and a half, you might have to take that serious. I think all countries might reduce their treasuries to the extent they can, and pension funds. And then there's also chatter about raising revenue by charging fees to foreign holders of treasuries. All those things, I think, play against us, and this all just feeds onto me. I think what we are seeing right now is damage to the American brand, and we've traded off, and I think this could be the mistake, though I guess I shouldn't say any mistakes would be made by you, given what you said earlier, but that we've traded off trade imbalances for capital flows. We were massive beneficiaries of capital flows and global brand recognition, where people wanted to be affiliated with the U.S., they wanted to be associated with the U.S. I think that has taken a turn for the worse, and that's what we're seeing play through markets, and I think it's going to start hitting corporate earnings as well. So that's why I remain bearish that we haven't yet hit the lows of this, cycle.
All right, Peter, we will be on to you again very shortly, no doubt. That is Peter Tchir, head of macro strategy at Academy Securities. The Nasdaq 100 closing the day down more than 4%, with Tesla and Nvidia leading the Magnificent Seven lower. Joining us now is Dan Ives, Global Head of Technology Research at Wedbush Securities. Dan, obviously we're seeing a rotation out of US tech. This is all part of, the maybe beginning to be a lack of confidence in US hegemony. Does it cross the gamut of US tech, or does it particularly hit chip companies? And is there any way back from this?
I mean, it's the hearts and lungs of the US tech world. And And I think that's the issue, is that executives you talk to, or even what we're seeing in terms of CapEx, I mean, you're going to see just massive uncertainty throughout earnings season. And I think it's not just about the stocks, and we've talked about it's about the real economic damage done here. But for U.S. tech companies, this would be like being in the ocean. They're in a boat, you flip them, no life raft, say, okay, good luck, we'll see you on shore.
President Trump obviously wants manufacturing back in the United States. If there's one area where there is spending, it's on things like fabs, it's on things like, chip making and so on. And he's, got some investments coming to the United States for that. Is there any reason to believe that he won't exempt all of these companies?
I mean, if you like iPhones being $3,500, we should make them in New Jersey or Florida. But the reality is that they would take Apple $30 billion, 3 years, just to move 10% of the supply chain. So my view is that it's one thing to talk about. The reality is we're talking about something that could take the U.S. tech industry back a decade, and that's why these China tariffs, that's the black cloud over the tech sector.
It's a huge black cloud, and it's not going to be lifted anytime soon. And it's under that black cloud that these executives need to give some kind of clarity on what their plans are. In terms of their spending plans, the story for the last couple of quarters has been about spending and investing in AI. How much is that going to be a theme this time around? I mean, can they turn off the spigot, or will they continue with some of what they had planned?
No, I mean, the shut-off valve's there. I mean, I think about 15, 20% of these projects automatically have stopped or significantly slowed down. The snowball starts going downhill, you can't stop it. And I think that's the reality. In terms of guidance, I'd be shocked if companies actually give guidance in terms of tech, because you don't even know rules of the game in terms of where they're going. So I do think investors will look through June. They'll basically throw out that quarter, September. You'll start to look through, can this be something in the next 60, 90 days that gets negotiated, and then to some sort of baseline. Then you start to look at 2026 numbers. That would be the bull case as a tech investor.
Okay, so hardware companies really have no visibility in terms of they are directly impacted by the tariffs. What about software companies? What about cloud companies that don't rely on overseas manufacturing?
That's really been our call, is that more of a shift in terms of names defensively. You look at Oracle, Microsoft, IBM, cybersecurity, Palo Alto, CrowdStrike, CyberArk, Fortinet, among some others, Checkpoint. I think software is going to be the one that's more defensive, less exposed from a tariff perspective, but clearly also impacted in terms of CapEx and projects. But I mean, you're going into, when it talks about hardware, semis, I think the reality is that there's the cost input, but then there's the uncertainty that's happening in enterprises. That's the big issue.
Dan, NVIDIA, it depends so much on TSMC, right? What is Jensen Huang thinking, given that one of the things China could do is cut off access to a Taiwan-based company?
I mean, look, that's what we've always talked about, is that when, as you go down this path, there's a lot of unintended consequences. And obviously, some of these black swan events will continue to be there. I think the bigger worry is that what does that do to the supply chain? What does it do to cost? Who's exempt? Who's not? That's the other thing, is that ultimately, what are the companies? Trump talked about it yesterday. Some could be exempt.
Yeah.
And that's going to be a huge variable. I can tell you, that's what investors are asking us: who's exempt, who might not be, and then ultimately, what does that mean for numbers when you look through it? Worst case, best case, base case. You're kind of taking that COVID playbook in terms of investing in tech.
I know when you talk about companies that are exempted, I think of Apple, because they were able to negotiate an exemption in 2018. And you mentioned Jensen Huang, Vani. He was just over at the White House over the weekend. What kind of convincing argument can he make to President Trump?
Well, I think the reality is that these tariffs, in my opinion, it's the body blow. It cuts the knees off of U.S. tech. And I think what Jensen would probably say is, look, you hurt us. Guess who wins? Beijing, China. Because that's the reality of the situation. So I think it's one where it's one thing in negotiations, but as you're doing it, you can't burn the house down. And I think that's the worry, and that's why you see these tech names selling off the way they are. Obviously, after the rally yesterday, is that you don't know the E with a PE. You don't know what that E is. Investors are trying to figure it out.
And NVIDIA doesn't report again until the end of May. We might know more by then, although we may not. Our thanks to Dan Ives, Global Head of Technology Research at Wedbush Securities.
All right, let's bring you some other news outside of financial markets. This happening in New York. There was a helicopter that crashed in the Hudson River on the west side of Manhattan. This is according to the FDNY. We want to get you the latest here and bring in Bloomberg's New York bureau chief, Katya Porzekanski, for a little bit more. Katya, what can you tell us about what we know so far?
Well, so far we know that the helicopter had what's believed to be 5 people on board, including, I believe, 3 children, and at least two have been, 2 of the passengers have been rescued and taken to a nearby hospital in Jersey City. We still do not have confirmation on the operator of the helicopter or the purpose of the flight. Some flight radar suggests that it might be a tourism charter. I believe that's most of what we know for now. This is reminiscent of a crash that we had in New York City almost 10 years ago, also in the river, that brought a lot of awareness to the harnesses that they wear and the ability to get out of the water.
Yeah, and we're looking at live pictures right now, Katya, and conditions don't seem to be particularly clear. It does seem to be a rainy, perhaps even a little bit foggy of a day, but helicopters take off and land at that area all the time, right?
That's right. I will also say this is a very crowded part of Manhattan. This is in Lower Manhattan, off Pier 40, which is off of Hudson River Park. Tons of businesses in there and homes. Lots of traffic right now on the West Side Highway and the Holland Tunnel as a result of this. And yeah, that is had this occurred just closer to shore, this could have been an even greater disaster. But yes, we still do not know the cause of the crash.
All right, Katya Porzekanski, thank you so much. And just to recap here, there was a helicopter crash in the Hudson River west of Manhattan. We will continue to keep you posted on further developments. This is Bloomberg Markets The Close. We have the S&P 500 closing the day down 3.5%, resuming its sell-off down for a 5th day in 6. The Nasdaq also giving back a big chunk of its gains as well from yesterday after we had the biggest rally since 2008 on Wednesday. This is The Close.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president now how he wants to negotiate.
China has been fairly measured so far.
There's going to be stickiness to these tariffs.
Where is this leading to?
The state of the world is completely in flux.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case very quickly becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
All right, we want to talk about inflation because we did have a CPI report today that came out and it was better than expected, but if you look within it, there were still some concerning areas. For instance, egg prices hitting yet another record, rising 5.6% in March and doubling from a year earlier. Here now to discuss food inflation overall, the impact of tariffs is Stu Leonard Jr. He is president and CEO of Stu Leonard's. It's a family-owned food retailer, food grocer in Connecticut. Stu, always a pleasure to speak with you. I guess I want to get straight to food prices and how you see tariffs affecting your products. How much of your products are sourced outside the U.S.? How detrimental are the tariffs to you?
Well, one cool thing about Stu Leonard's is we're probably 80% fresh, where most supermarkets are probably like maybe 50%. So we rely heavily on fresh products. Most of that isn't tariff. A couple of our big guns are salmon out of Canada right now. We do about 1 million pounds of that a year, and right now we're okay. So salmon prices are the same as they were. Another thing you get into, which gets me a little nervous, are these little babies right here that everybody loves. It's our #1 selling item in produce, believe it or not.
Avocado.
And believe it or not, it's a fruit. Okay, so you know that with the guacamole and everything, I can't really buy avocados anywhere else except Mexico, and that's exempt right now. So I got 2 biggies that are exempt. The things I worry about are things like this tequila right now. It's coming out of Mexico. You can't buy that anywhere else in the world, okay? But our suppliers saw this tariffs coming. They said, cool it, Stu. You got probably 90 days before there'd be any price increases.
So
we're yeah.
Sorry to interrupt. I kind of want to pick up on that. You know, the commentary that they provide you, the assurances that they give you. You have 90 days to sort things out. What are those conversations like? Are your suppliers offering to eat some of the tariffs, or are they, negotiating with you to take on some of it? How do you split that?
That's a great question, and it has to be handled different depending on the company. Like, we deal with a lot of small local farms and ranches out west and everything. These are family businesses. They're small. I'm not going to put the screws to them and say, we're not taking any of your tariffs, okay? Some of the bigger companies are taking a harder line. We just got a call from an Irish butter producer that, they want to increase prices 10% right away. We said no. And most of the blinking lights out there, and it's probably the same with the market, same thing. Nobody knows what's going on. Nobody knows what's going on with food right now. But the big thing is wait and see. That's what we're hearing from most of our suppliers. We're on the phone every day with these people, sometimes multiple times a day, because things are changing so fast.
Well, for sure.
Yeah.
For sure, people will miss their Irish butter, Stu. I have to say that in there. Yeah. But talk to us about stockpiling. You said you had some suppliers that said, cool your heels. There's going to be a few more weeks. But are you getting extra shipments then? Are you getting extra product and stockpiling it in case what happens in 6 weeks is what you were anticipating would happen now?
I would say most of the non-perishable food items we have stockpiled, and so have our importers. Like, for instance, our pasta out of Italy, our marinara sauce that's made over in Italy, our olive oil. Reggiano Parmesan is not like a great alternative to that. If people want the Reggiano, they're going to want it. But there's a lot of items you can buy U.S. For instance, even we got Easter coming up. These are beautiful lamb chops right now, okay, from New Zealand. But the United States has great lamb chops in Colorado. Take wine or champagne, for example. Here's a great bottle of California and Sonoma Valley champagne. It's sparkling wine, so it's not champagne. But the same family that makes it over in France makes it here. So the big question we're looking at is how much shifting is going to go on from foreign-made products over to U.S. products. Like here's an example of a big wheel of French brie right here, okay?
Stu, you're making us hungry.
This is... This will This is $2 a pound more than the United States brie.
Yeah.
So I did a little taste test yesterday, and most people like the USA brie more. So is the customer going to shift right now? That's really what we're waiting to see what will happen.
Stu, what about the products that are paper products that we might think come from U.S. companies, but probably source a lot of it from places like China and other, Southeast Asian nations? And I'm talking about, toilet paper makers and kitchen paper makers.
Hey, why is toilet paper such a big item? We found that during COVID, too. I almost don't want to hear about it anymore. I mean, it seems to be the #1 item. People like to stockpile whenever they're a little concerned about food prices and stuff. I mean, I have 4 daughters and a wife, so I understand the toilet paper thing. Mm-hmm. But, I'm not worried about grocery too much. A lot of that's U.S. made. There's odds and ends you get imported from Europe. Fortunately, we don't get anything from China. No food comes from China at all. So, we're going to probably feel it in some of the packaging expenses and things like that. But I don't think customers out there have to expect any, at this point, shocking increases. You might see bananas go up 5 or 10 cents a pound right now, okay? Those are coming from Costa Rica. Same with pineapples right here. So you might see a little bump, nothing serious.
Stu, I'm looking forward to price reductions on things, and I know that might be a tall order here, but you did mention that because you're not importing a lot of things from China. Of course, a lot of the U.S. exporters are not sending things over to China as well. Talk about lobsters, especially as we get closer to the warmer weather.
Yeah, well, lobsters are pretty calm right now. Nobody's really into it, but they're going to be exploding when, within the next month or two right now, usually by Mother's Day. So at least in the Northeast. So we're going to be doing a lot of lobsters right now. We've been talking to our Canadian lobster farms up there. But we also have we have 60 boats up off of Stonington, Maine. We've been up there to the nicest people in the world. So we're going to start buying more and more from them, which is a Maine lobster zero tariff on it. So the big question I have, and I don't really understand the lobster global industry, but I know we ship a lot to Japan and China too. So, that's going to maybe offer more supply here on the U.S. side, and maybe you'll see lobster prices go down this year.
Well, Stu,
I'm hoping for that.
Yeah, exactly. Stu, you're like Mary Poppins. You literally had every product to hand right beside you there, except for those lobsters, of course. We'll wait to see the lobsters next time. Our thanks to Stu Leonard Jr., President and CEO of Stu Leonard's.
All right, and of course, we got to recap what happened in trading today. I don't know what it says about this market environment, Vonnie, where 3.5% on the S&P 500, a loss there feels kind of like a normal day, especially in the last couple of days. 3.5% down in the S&P 500. There was some rotation to some of the safer sectors like consumer staples, but really it was down all across the board, across asset classes. You could see yields rising as prices fall on treasuries, especially at the long end of the curve. There was a 30-year auction that met decent demand, but still we have a lot of big question marks over what the fiscal picture of the United States looks like. The dollar lower by 1.5%, perhaps reflecting flight out of U.S. assets, and crude oil now at $60 a barrel when it comes to WTI.
Yeah, it was an insane day. Gold at a record basically as well, and we just have to wait and see what happens tomorrow after we get another response potentially from China tonight. Well, President Trump successfully corralling House Republicans to approve a Senate-passed budget outline, paving the way for a tax cut package and debt ceiling increase. Joining us now to discuss this and lots more is Libby Cantrill, Managing Director and Head of Public Policy at PIMCO. Does this become the story now, Libby, at least at some point, where you can, talk about the debt ceiling in relation to these tariffs, and it suddenly becomes more intertwined again in the public consciousness?
Yeah, well, I think the Trump administration really wants the narrative to be around tax cuts, right? We've been describing this as a combination of vegetables and dessert for our clients. We've had a lot of vegetables in terms of tariffs, the Doge headlines, and now they really want to pivot to the dessert, which is, I think, going to be, they hope is going to be the tax cuts. The composition of what those tax cuts, though, look like, I think really are to be determined. The upshot here, though, is I think the
there's a $1.5 trillion number that's being floated around. The real number, though, for the Treasury market is more like $5.5 trillion, because this budget actually includes, as a policy baseline, just an extension of the Trump tax cuts that costs around $4 trillion over 10 years, plus an additional $1.5 trillion over 10 years. So that's going to be, again, maybe not necessarily assuaging the bond markets in terms of really getting the sort of the fiscal house in order, despite maybe some of the rhetoric from the budget hawks.
Yeah, exactly. And the bond markets have been throwing their own sort of mini tantrums here, right? So there's a lot to consider, and we get the score, then there'll be a lot more to consider. What's the earliest possible date that we'll see something actually effectuate?
Yeah, so you mentioned the debt ceiling, and I think importantly here, from maybe a good thing for the bond market here, is that we probably won't see some of the volatility that we've seen before in terms of a debt ceiling increase. That debt ceiling deadline, though, that could be as early as May or June. I think that will be actually a forcing mechanism to get this thing done. So we're probably looking at a summer time frame, kind of at the latest at this point. Again, I think the president and Republicans on the Hill really want to change the narrative. They want to pivot from some of the implications of tariffs, a headwind to growth, upward pressure on inflation, to some of the risk market tailwind that is associated with tax cuts.
But when it comes to tariffs, the amount of revenue that it's expected to generate has gone down because President Trump rolled back so many of the tariffs that he had announced on April 2nd. According to the Yale Budget Lab, they now expect all of the latest announcements to raise about $1.82 trillion in revenue over the next decade. That's a far cry from how much the tax cuts will cost.
Yeah, I mean, I think that, well, it remains to be seen. There's a lot of, I think, wiggle room in those numbers. I mean, I think our economists have put this together, and it looks like it could raise up to $400 billion a year. It sort of depends, though, right? It depends on what consumers actually do in terms of the substitution of goods. The one thing I think that, and maybe the market is internalizing this today, is that the headwind from tariffs, the tariff level is going to be very high, even if he doesn't add on any additional tariffs in 90 days. So if you just think about the 10% universal tariff on everything, the 100 and whatever it is, 45% on China. I mean, it keeps going. Yes. The sectoral tariffs, the tariffs on the non-USMCA compliant goods. So I think from a growth and from an inflation perspective, these tariffs are very likely to still bite, even if we maybe avoided the kind of the worst possible scenario.
So taking a step back here, when we look at how the Trump administration is rolling out its economic policy, how it's moving forward with everything, personnel is policy, and we've seen different voices come out and they're fighting for supremacy. Whose voice matters right now most to you as you listen to different people come out? Is it Navarro, who seems to have taken a step back because of the rollback in tariffs? Is it Scott Bessent, the Treasury Secretary, who made really clear that he was dealing more with the tax situation rather than tariffs? Or is it Howard Lutnick?
Yeah, so I think, obviously, given our remit as bond managers, we're always going to pay a lot of attention to what the Secretary of the Treasury says. But even though they're sort of shades of gray in terms of what they are all saying, they really, Secretary Bessent included, are really echoing the president's view on trade in particular. So again, maybe shades of gray, Peter Navarro maybe at one end of the spectrum, but they're all talking about what their view is around trade deficits being bad, trade deficits being symptoms of broader problems in terms of not only unfair playing field in terms of tariffs, but taxation, currency, industrial subsidies. And also, they all believe that tariffs work to some extent. Now, are they revenue generators? Are they a means to an end? Are they an end to themselves? I think they're differing views. But I think that is kind of what we are guiding our clients to, is that the president believes in this. He believes trade deficits are bad, tariffs are good, and everyone around him pretty much shares that worldview, even if, again, there's some shades of gray.
Libby, what can we say about the president's potential impact on the markets now after yesterday? So we saw yesterday there was a very, very temporary impact on the market. It seemed like it was going to be a long-term impact, and today the markets have forgotten again, President, I don't want to call it the Trump put. Yeah. I don't like that phrase. Yeah. But I do think that this sort of proves that the president really can't do anything about this unless it's policy that he's actually creating.
Yeah, well, I think a couple of things from yesterday. I mean, just in general, we have seen that the president's pain threshold for sort of market indigestion, if you will, is much higher than it was under the Trump 1.0. And I think a lot higher than a lot of market participants assumed. I think, again, maybe they were not underestimating the passion in which he really believes this, the ideology around the sort of worldview around trade. So that's one. Two is that as of yesterday, he's paying attention, as much attention to the bond market as he is to the equity market. I think Trump 1.0, very focused on risk assets. Trump 2.0, and probably led by Secretary Bessent, he really is paying attention both to the functioning of the bond market, like any kind of politician or policymaker would, but also to that 10-year rate. And Secretary Bessent, in particular, has put a lot of emphasis on that rate. So I think, again, we've seen a higher pain threshold from the president. He, of course, is attuned to the markets. But what we have seen broadly from this administration 80 days in is a more maximalist view. He believes there's a sense of urgency. He believes there's limited time to effectuate change, and he's really committed to that change.
All right, good stuff. Libby Cantrill, really appreciate your joining us. PIMCO, Managing Director and Head of Public Policy. And we want to broaden this out and talk a little bit more about what the public policy means for the economy and for companies and their confidence, because Wall Street is racing to really game out the tariff impact on earnings as well as the economic picture. Joining us now is Roger Altman. Roger is founder and senior chairman of Evercore. The firm handles over $2 trillion of mergers and acquisitions, recapitalization, and restructuring transactions. We should note as well, Roger previously served as Deputy Secretary at the U.S. Treasury. He has worked in the Carter and Clinton administrations. Roger, thank you so much for joining us. Really appreciate it. And this is a great way to kind of wrap up what we've seen so far this week. How much damage, in your mind, has the turmoil over the past week created on corporate confidence?
A lot. I made a point this week so far of speaking to quite a few CEOs of large cap companies in order to exchange views on the financial market turbulence and the implications of it, and to ask what they were feeling or sensing in their businesses. And across the board, they're either already detecting some weakness or expect to see it shortly. So the level of business confidence is weakening because business conditions themselves are starting to weaken, which is not surprising given the shock and awe character of these markets in the last few days, and the dimensions of the tariff war.
A bunch of Wall Street voices have been speaking out this week. We heard from Bill Ackman, we heard from Jamie Dimon, we heard from Elon Musk as well, who plays a prominent role in the Trump administration. Jamie Dimon seemed to break through, the chairman and the CEO of JPMorgan Chase. Based on what you've observed and in your conversations, what's been an effective and perhaps the most effective way to reach out to this administration and to let him know, let President Trump know some of the costs of his pursuit of his policy and maybe convince him to slow down?
Well, Scarlett, it's pretty difficult for almost any CEO, maybe not Jamie Dimon, but almost any CEO, to by herself or himself make an impact on the Trump administration's approach to tariffs. I think that's asking a lot for any individual CEO. Most of them, after all, only talk to the media on a regular basis at the time of their earnings calls, and they're not a constant presences in the media ecosystem. So I think that's just a lot to ask. But I can tell you that in private, there's almost universal disaffection toward the tariff policy, because after all, if you think about it, the idea that if country A is running a trade deficit with country B, then by definition, country B is ripping off country A is simply fallacious. There are lots of reasons for trade deficits, and they're not all bad ones. For example, the United States is not a serious coffee producer. Brazil produces a lot of coffee. So we buy tremendous amounts of coffee from Brazil and certain other coffee-producing countries like Colombia, and we don't sell them any coffee. That's not a bad thing in and of itself. Furthermore, exchange rates have a lot to do with trade deficits. Also not a bad thing in and of itself. So the very premise of the trade policy, that any trade deficit with any particular country reflects they're ripping us off, is just not seen as logical by the business community, or for that matter, anybody who seriously thinks about it.
Roger, just looking at the markets, we're seeing IPOs getting delayed, we're seeing deals getting put off, we're seeing money flow out of leveraged loan funds, we're seeing spreads widen. Are you anticipating any kind of market event over the next day or two if this doesn't settle down?
Well, today you saw an alarming thing. You saw the dollar weaken, bonds weaken, and equities weaken at the same time. That's quite uncommon, because typically it's not common to see the dollar weaken and bonds weaken at the same moment.
Right.
That happens often in emerging markets, but not in the case of the United States. That is not a good sign, because it signifies capital outflows, and it signifies diminishing confidence in the growth outlook for this country, and for that matter, the attractiveness of dollar-based assets. So I don't know if that continues or it's a one-day thing. No way of knowing that, but it's not good.
On that point as well, Olivier Blanchard was on X this week saying that China does seem willing to sell U.S. Treasuries, even if it means absorbing capital losses. What's your take on how much China is willing to sell U.S. Treasuries and what that might mean?
I don't know the answer to that, Bonnie. I don't know that anybody outside of the Chinese leadership could possibly know the answer to that. But again, think about today. Typically, when bonds weaken and yields go up, the currency strengthens, because on an overnight basis, you're getting a better return on it for holding it, right? Higher interest rates mean better return if you hold the currency, even overnight. So this is, I said, quite an uncommon dynamic. Now, we'll see what happens tomorrow and what happens beyond it. Mm-hmm. But I think the markets are essentially saying they don't like this tariff war at all, and they want it to be unwound. They want it to be stopped. That's the message, especially of today's reversal relative to what happened yesterday.
Well, sorry to interrupt.
And that's what the market is saying.
That's what the market is saying, and I think the intention was very different, that the tariffs would push yields lower, and the Trump administration has put a huge premium on lower yields, which would reduce borrowing costs for companies and consumers, but also make it less expensive to refinance government debt that's coming due. There's this theory that they were intended to do just that. Besant reportedly said that for every 1 basis point reduction in the interest rate that government pays on its debt, that would save $1 billion a year. Is that a sound strategy, Roger?
Well, if you're asking whether the expectation of lower yields was sound, let's just say it's not working out so far. But if you step way back, and you imagine day one of this administration, and the announcement is, let's have an all-out economic war between the two biggest countries on the planet economically, which would be the United States and China. Why would anybody think markets would think that's a good idea? Of course they wouldn't, and they don't.
Roger, you've been in politics and finance for decades now. I mentioned your credentials earlier. There's an interesting story on the Bloomberg Terminal, which has gotten a lot of clicks, about a JP Morgan strategist who wrote a report but then redacted large parts of it so as not to anger the White House and put the firm in the crosshairs of the president. Has that ever happened to you? Is this an unusual thing to happen?
Well, I can't speak, Scarlett, for JP Morgan and what they may be thinking about matters like that. I don't know. Mm-hmm. I don't think it's quite very common, but maybe there were some special factors involved. I just don't know. Maybe they're having conversations with the White House On the side, not sure.
Roger, what do you anticipate a U-turn to be? At this point, the president, he did a mini U-turn yesterday, right? But he didn't do a full one. He didn't take off the tariffs that are now already in place. So what does definition look like?
Well, what makes me concerned, at least on this one question you're asking, is that the biggest piece of all this is the U.S.-China bilateral economic and trade relationship. And it's a little hard to see right now how the tempers may cool and the war that's broken out here, economically speaking, may turn into peace. It's hard to see that. That's the one thing that I think would enable markets to calm and return to stability. A ceasefire in the U.S.-China war. People say, well, China has a lot more to lose because they expect export more to the United States, of course, than we do to them. But I don't think that's the core point. Again, if you have the two biggest countries on earth economically in an all-out economic and trade war, it's just not a good thing. And that's what's going on at the moment.
So, Roger, final question to you. How do you advise your clients, your corporate customers, how to move forward right now in this period of great uncertainty when we don't know what's going to happen and companies still need to move forward and make decisions?
Well, the problem is the financial market turbulence and the beginning of some economic softness that some of them are seeing. I don't talk to every single company, so I can't say that everyone's seeing it. I'm sure they aren't. Is causing them to adopt an approach of caution. And in practice, that means caution on hiring, caution on capital expenditures, caution on other forms of expansion. There's a cautionary mindset right now that was not the case 2 months ago. And that in itself isn't good because it becomes self-fulfilling in terms of economic weakness. Most of them expect that GDP this year is going to be, GDP growth is going to be minimal, or possibly by the end of the year even turn negative.
Roger.
And they did not expect that a couple of months ago.
We got to leave it there. Roger Altman, thank you so much. Founder and senior chairman of Evercore. That does it for The Close. Keep it here for Balance of Power next.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
In case you missed it on the opening trade.
Is Trump, as he says he is, ready to do transformational trade deals as long as he gets his interests taken care of? Because if he is, that gives a huge opportunity for the UK to really move the dial on its growth with the US. So I can't imagine that you would shy away from that prospect if it's genuine. What remains to be seen, is it genuine on the part of the US? And we have to test that.
Don't miss the opening trade, live every weekday.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power. Alongside David Gura in for Joe Matthew, I'm Kaylee Lyons.
A sharp reversal on Wall Street as President Trump warns of, quote, transition problems from his tariffs policy. And the White House clarifies the levies on some Chinese goods could be as high as 145%. Have analysis from Joanne Feeney of Advisors Capital Management.
Plus, we'll hear directly from a member of the administration this hour as Small Business Administrator Kelly Loeffler joins us to discuss the impact of the president's trade policies.
And Democratic Congressman Mike Levin of California will be here, too, after the House narrowly passed a budget blueprint today. It clears the way for work on Trump's tax cut agenda.
Thanks for being with us on this Thursday evening and another wild day on Wall Street because of Washington. I think we could argue, David, as the market wakes up to the reality that even though there is a 90-day pause on reciprocal tariffs, there is still a really escalating trade war between the U.S. and China that has yet to be resolved.
Wall Street reckoning with the fact that this seems like a postponement. That 90-day period is going to go by quickly, and we heard from the Commerce Secretary today at the Oval Office. The phone has been ringing off the hook. There isn't enough time, he said, to deal with all of the calls that he's been getting from other countries and trading partners.
And yet China does not seem one of those countries picking up the phone, though the president in that cabinet meeting earlier today did express some optimism about potentially a deal. This is what he said.
Well, we'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. They've ripped us off beyond nobody. How people stood for it, sitting in my position, is not even believable.
Joining us now with the latest from the White House is our colleague, Laura Davison. Laura, let me just ask you, first of all, what we learned about the sequencing of all of this today, how this is likely to play out, what these members of the administration are saying about how these deals are going to be put together.
So it looks like that they're going to do this one by one. Trump has really become fond of the phrase of let's do this a bespoke, a tailor-made versus an off-the-rack kind of deal. So it looks like he's repeatedly suggested that Japan is at the front of the line, South Korea, perhaps Vietnam as well. But there's, 60, 70 countries who are wanting to make these deals. These are very complicated things. Typically these would be agreements that would be hashed out over months. So doing, dozens of these over the course of 90 days is going to be a very, very complicated task. Much like when they originally announced they were going to do these reciprocal tariffs, come up with this specific formula for each country. They ended up sort of doing a much simpler formula at the end. We could see something similar play out this time.
Well, and I guess the question really remains whether or not China is going to be one of those conversations that these officials will have. President Trump is seemingly expecting a call from Beijing, but we haven't had any indication that Xi Jinping wants to pick up the phone.
Not at all. And the Chinese Foreign Ministry has been very clear that, they are willing to go till the end on this fight. It's sort of like two lovers in a quarrel, and no one wants to be the first to say, I'm sorry. Trump has said he's clearly waiting. And again, we saw another escalation of another 20% or so on Chinese goods, up to 145% tariffs.
The math is just remarkable and kind of confusing, to be honest. Bloomberg's Laura Davison, thank you so much, as always. And now joining us for a look at the economic fallout from President Trump's tariff shift is Bloomberg's Enda Curran. So, Enda, we also heard the White House, many cabinet officials, the president himself touting today's CPI data, saying it's good news on inflation. But obviously, a lot of this tariff drama had not yet happened when these readings came in. Even with the just 10% flat rate that has remained in place, even if the reciprocal higher rates are not going in, what impact is that likely to have?
So the inflation data was good. Core and headline inflation better than expected. Prices for airfares, car insurance, that old suspect coming down, energy costs coming down. It was kind of a good read across the board. But as you say, Kelly, it was also ancient history because the real tariff shock is now coming. And to your point, first of all, we've got this 10% minimum tax on imports coming from around the world. Some of the sellers might swallow some of that margin, some of the buyers might swallow some of that margin, but a lot of economists are saying some of it will also leak into the economy. So that's price pressure. But really and truly, you can't look past 145% on goods from China, America's second or third biggest trading partner, depending on how you slice and dice it. That's all of the stuff that we buy every day of the week. That's obviously going to flow through to consumers.
And what we've seen in terms of market reaction has kind of overshadowed what I think is happening in C-suites and smaller executive offices across this country. How are companies dealing with this, I guess, postponed uncertainty about how these tariffs are going to go into effect?
A lot of confusion, a lot of uncertainty. They don't know what trade policy is going to be. We speak to companies a lot. I spoke to one yesterday who was put on hold an order for a shipment of the outdoor picnic chairs he makes in Cambodia, thousands of them. He's told his factory in Cambodia, you keep those there until we get things sorted out on the US side of things. Small business confidence through the floor. It's taking the biggest hit since the pandemic. So a lot of uncertainty for terms of investment and hiring plans among business people until this is clarified.
And great to speak with you. And Curran covers the economy for us here at Bloomberg. Thanks very much for your time. And joining us now with a check on where markets ended the day is Bloomberg's Scarlett Fu. She is live in New York. And it was red across most of the screen. I guess gold was the exception, Scarlett, but a lot of red on the screen today.
A lot of red on the screen. A day after the biggest rally since 2008, stocks resuming their sell-off with the S&P 500 down for a fifth day in six, really giving investors whiplash. You can see the big red arrows there for the NASDAQ and the Russell 2000 as well, each down by at least 4%. There were some bright spots in that investors rotated to safer havens like consumer staples companies, defensive companies that would hold up in a slowing economy. And that's really the problem, the economic damage from the tariffs, and in particular, the uncertainty and loss of confidence in the U.S. exceptionalism story that had driven the S&P 500 to 20% plus gains over the last 2 years. The bigger concern, though, really is in the U.S. Treasury market, because rising yields is what caused, or a lot of people say is what caused President Trump to blink and pause on his tariffs for most of the world, save China. There were some critical auctions this week, the 3-year and the 10-year and the 30-year. The 3-year met with some not so great demand. The 10-year and 30-year were better received, but yields continued to climb. And that is a reflection of the slowing economy, and also the fact that the Federal Reserve, guys, is not really in much of a position to provide relief because of the expected perhaps pickup in prices that the tariffs would bring.
Yep, which Endo was just telling us about. Bloomberg's Scarlett Fu, thank you so much. And of course, we keep in mind as we watch the markets today, earnings season begins in full force tomorrow with JP Morgan reporting before the bell. That's going to be fun. And still ahead, we'll have some more fun here as we dive deeper into the tariff-induced market volatility with Joanne Feeney, portfolio manager at Advisors Capital Management. She's next on Balance of Power on Bloomberg TV and radio.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO? It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg. The top names at the Fed are on Bloomberg.
I do know that consumer sentiment has started to take a dip. The question that we face right now is consumer sentiment going to be a leading indicator like it was pre-pandemic, or is it going to be something that doesn't really translate into actual observed behavior in the economy, that as how it played out for most of the pandemic? Right now, it's an open question, and it's one of the things I'm going to be watching very closely in the months to come.
Nobody covers the Fed like Bloomberg.
The retaliatory tariffs, you have a situation where basically production sort of grinds to a halt because there's these interdependencies, and that is very bad. It's almost like another COVID in that it raises costs, it lowers revenues for companies, and it worsens the capital markets.
Ray Dalio, founder of Bridgewater Associates, earlier today discussing the impact of President Trump's tariffs on businesses and the markets by extension. For more analysis, we turn now on Bloomberg TV and radio to Joanne Feeney, portfolio manager at Advisors Capital Management. Joanne, thank you so much for being here. We obviously saw quite a reversal today after the best day for stock markets going back to 2008. And I wonder what you think that is a reflection of just lingering uncertainty around these tariff policies out there, or reality that a trade war between the U.S. and China alone is enough that you don't want to put risk on?
Yeah, I think, Kaylee, both of those things. A 90-day delay certainly gives the administration a chance to negotiate. But we have to remember that tariff rates were virtually zero around the world before this whole thing started, and putting 145% tariffs on China, interferes with an awful lot of production, cheap production that U.S. consumers and U.S. businesses have benefited from for many years. So that's costly to firms. It's costly to consumers, and I think that today's decline really reflected more that yesterday's surge involved a lot of short sellers covering their positions, and so the damage has been done. The uncertainty is not going away anytime soon. We don't know where this administration is going to take these tariffs ultimately.
Joanne, how do you navigate the volatility? We've seen these wild swings in the indices themselves, but when it comes to the VIX and other measures of volatility, wild swings there also. I suppose that's likely to continue. How do you kind of position in as a result of having that heightened volatility?
Yeah, David, I think one thing is sure is that the uncertainty isn't going to go away. So volatility is not going to go away for some time to come. I think we're also seeing, though, some repositioning, all right, of portfolios. And what we do at Advisors Capital depends on the particular strategy. When I manage the balanced strategy, which is one of our more conservative approaches for clients, what we're looking for on the equity side is to design a buy list, design a set of stock holdings that's, first of all, diversified across sectors. And to deal with this kind of volatility, we made moves early in January to take some risk off the table, to move clients into companies that were more domestically focused. But also a big advantage for clients can be the income that's generated off these strategies. We actually target yield levels and income levels on the fixed income side so that clients can more easily ride out these periods of volatility. They know they're getting those dividends. And if you own companies that have good cash flow that can ride out even recessions, they're going to continue to get those dividends even if stock prices and the economy slows down some.
Well, we often associate companies that have strong cash flow with things like tech, for example, but tech also has the exposure specifically when it comes to China, Joanne. So do we need to redefine what is considered safety in the U.S. equity markets? Is this kind of a staples is the only thing you can really count on situation?
Yeah, I mean, safety is always hard to find in the stock market. So we should be clear. You're investing in equities. Sure. You have to be prepared to ride out some volatility. But, to your point, Kaylee, there are some places that are safer than others. Utilities is probably a very safe place to be, and it's also a good place to get income. Staples, obviously, will outperform because they're necessities. It's something that consumers will have to buy. They'll have to trim elsewhere. And so there are more areas than that, though, and healthcare might be one of those if you're careful. Obviously, pharmaceuticals and tariffs are now vulnerable, but there are companies like Quest Diagnostics. People still need lab work work done, no matter what's going on with the economy. That's an example of a relatively safe play. And even in consumer discretionary, TJ Maxx is one we've owned for clients for a very long time because it actually does well in most economic environments, but particularly particularly resilient in recessions because of where they source their products that they then turn around and sell to consumers who often trade down and come shopping at TJ Maxx instead of shopping at Macy's during times of economic stress.